Well, first of all, I want reassure everybody that's watching that we're in constant contact with market regulators. Secretary Mnuchin, Gary Cohn, and I have been following a lot of the things that your previous guests were talking about, just to make sure that things are proceeding in an orderly, if disappointing, fashion over the last couple of days. The fact is that the president's tax cut and the regulatory reforms are supply-side reforms. What they should do is increase capital spending, something that we see very sharply in the data. That should increase supply and actually put downward pressure on prices. You know, I've been out there saying, really throughout the tax debate, I even said it on this show, that we believe that, and we've modeled this, that the positive economic growth you get out of a supply-side boost does not put upward pressure on prices. And so that when we model future interest rates, we get a path of interest rates that's very consistent with the Fed's forward guidance. And so now, you know, what set off the last couple of days clearly is the very strong economic data, which shows that our analysis of the economic data is really correct, right? But the data are so strong that clearly markets are starting to worry about Fed policy. Now, it's not my job to inform the world about Fed policy. We respect their independence, but I can say that when we model it, the future interest rate path looks pretty much like the Fed's current forward guidance to us.
Kevin, the president obviously has used the market as a scorecard oftentimes for his own success or failure at any given point during this presidency so far. In fact, has said that the tax reform cuts, in terms of looking at that, has said that's been a success because look at the market. How do you guys internally think about that now?
Well, sure, there have been a couple of bad days, and if you go back to the day he was elected, I think we're up by about a third. I think that the way to think about it is, let's go back to economic theory. In economic theory, before the tax reform, if you earned $1, you got to keep 65 cents of it. After the tax reform, if you earned $1, you get to keep 79 cents of it. And so 79 is a lot more than 65. You can do the percentage yourself. You know, that's about what the value of an equity should be if it's the present value of discounted after-tax cash flows. And so we expect that, you know, that would act as an attractor for the market, and that over time the market would head there. But nobody knows what the market's going to do today or tomorrow. You know, that markets are reasonably efficient, especially in the short run, and they're very volatile as well, as we've seen over the last few days.
Yeah, Kevin, that's what we've been kind of bumping around here, just trying to figure out the reason for why this happened. There's not a lot of clear indications in terms of fundamentals. The economy hasn't changed our outlook. Earnings outlook hasn't changed much of anything. What do you think sparked all of this?
Well, I think that, you know, getting inside the mind of the market is difficult. The economic fundamentals are really strong, and you know, earnings growth forecasts are certainly going to be revised upward given what we're seeing. You know, the Atlanta Fed has a 5% first quarter, which is, you know, while that thing's probably going to revise down, don't forget that in the fourth quarter we had massive private demand in the economy, above 4%, and the reason GDP came a little bit below 3% was that we ran inventories down to the bone. And so in the first quarter, they're going to have to rebuild those inventories, which means we're going into the year with very, very strong economic growth. And so with all of that in the backdrop, then you would have to say that people would be concerned that discount rates for those future cash flows are changing, which is something, can I finish the last thought, Aaron? That one of the things that I have also been saying on the show over really the last few months is that, you know, when President Trump took over, we inherited an economy that was growing in the ones. And you know, the economic team of the previous president was telling us it was secular stagnation. We're stuck there forever. What we're saying is, no, they were making policy errors, and if we fix those policy errors, we can get growth back to normal. So guess what? Growth has headed back towards normal, but normal involves a lot of other things too. And I think that what we're seeing is that interest rates seem to be moving back to normal now as well.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.